remarkably sound system in this regard. Finally, we had the thoughts of the larger questions. And one of the great puzzles of the crisis is that this thing of too big to fail has certainly turned out to be true by and large. In fact, now they're even bigger to fail. And some of the consequences of these decisions are going to be faced down the road. And the question which we'll have to come to is how to align the incentives of these key players, and think a bit about whether or not this in fact is the steady state which we wish to encourage. One thing in finance which people often talk about is a thing called financial innovation, which I learned is a very important topic close to the heart of many of my colleagues throughout Columbia, and we endorse the innovation very strongly, particularly the OTC market and some of the innovations which happen in the OTC market. But we had a very spirited debate yesterday about what happens when you have an innovation called credit default swaps, which has a notional value of $60 trillion to $75 trillion in the world. Maybe that's some time to take the innovation off the marquee and to think about this in a more regulated fashion, perhaps through a clearinghouse and other mechanisms. And it's surprising how much passion is actually spilled on a table over whether or not you should have a clearinghouse or just let it stay on the OTC. And then finally, this financial democracy. And we wanted to have a discussion about issues of equity and fairness and politics behind this. We're putting this on the shoulders primarily of Howard Rosenthal today to bring this message to us. But it's a very important backdrop to this whole debate. Stefan Meyer will talk about financial illiteracy. He'll show you very clear data on what actually people knew about their loans. But there's also a sense of a larger mandate about bringing markets, despite this crisis, to areas of the economy which have not been touched by it. And we still feel this is an important regulatory objective which we should discuss. Those are a modest set of recommendations. It's a modest little conference we're having. So I have the pleasure at this point to step out of the ring of action and let my friends go forth and discuss it. Before doing that, I'd like to introduce Glenn Hubbard, who is the dean of the school. But I think we all know that Glenn is much more than just the dean of the Columbia Business School. We're lucky to have him as our dean. But he's also someone who has played a major policy role in past administrations. He's a person who is a well-known public figure in this debate. He and Chris Mayer, which Chris will discuss later, have an interesting proposal on the mortgage aspects. It's a great pleasure, Glenn, to have the honor to introduce you. Thank you.
Thanks, Bruce, very much for those kind words. And I think that you should all know that these proceedings, I believe, will be taped for YouTube. And there I bring you some good luck. As somebody who has a 2 million hit YouTube video, maybe I can be your good luck charm today. And I will be in and out with you with what proves to be, I think, a truly great program. And thanks to all colleagues for putting it together. I would argue that business schools, obviously Columbia Business School, but any top business school should be the place for this kind of discussion. These are going to be extremely big issues, not only for the education of future business leaders, but for our economy. Indeed, it is my forecast for you that next year, 2009, will be like 1933, by which I do not mean the real economy. I know there are many economists who are more dour than I am, and they can keep that. But I mean in terms of a total rethink of the nation's regulatory processes, for better or for worse, so this comes at an excellent time to have the conference. I actually like thinking about financial crises. Economists are generally a little strange, and I guess I'm part of that. My own work over many years has really centered on financial crises in thinking about investment collapses, some work with Mark Gertler many years ago on how macroeconomic risk perceptions affect, at least in theoretical models, the likelihood of financial collapse and over-leverage. Some economic history work with Charlie Calamiris, and indeed a volume that I had the privilege of editing with some friends, some of whom are in this conference, in 1991 at the National Bureau on Financial Crises, where Marty Feldstein okayed the project because he thought I had an interest in economic history. This has also been a topic of policy interest for some time. I know that when I was on the President's Working Group, which was principally to provide adult supervision for Paul O'Neill, but also gave me a chance to look into policy, there was a great deal of discussion, even early on, of many of the issues we'll talk about today. Now, what happened this time? As economists, we know there's something special about this time. In the public's eye, the set of shocks that hit the economy actually in the 2000 to 2002 period might have been more compelling for a major recession. After all, there was a significant terrorist attack, an investment collapse, collapse in public equity values as an asset price, corporate accounting scandals, and the drumbeat for war. The economy, of course, did not have a very significant recession. To get very significant recessions, if one looks at the data both in the American experience and the worldwide experience, one does need a financial propagation element, and that has happened this time. Now, much attention in this crisis has been paid to housing, and I assume that that will be part of your discussion today. And I think the reason for that falls into the categorizations of that great economist, Don Rumsfeld. Now, you know that Don Rumsfeld categorized all the world into three parts, much like Caesar did to Gaul. Just think of three parts. One is known knowns, one is known unknowns, and the other is unknown unknowns. Now, the last of these is what's interesting for the conference. The known for housing was that residential construction, the direct arithmetic element to GDP, had likely peaked even in 2005. This was well known to economists. The Fed was talking about it. There was an important known unknown of what would happen if house prices fell. Now, I say what would happen. Now, of course, we're concerned about it. But at the time, this was a matter of historical interest. Since the Depression, there had been no national decline in house prices. And there's been a big debate in our profession over the wealth effect of that. But the unknown unknown that I think everyone missed, or at least I missed, was the fact that losses in the hundreds of billions of dollars, surely now within daily fluctuations in public equity markets, would be enough to blow a hole in the financial system. And the reason being classic bank run logic: when you don't know where losses lie and a mountain of leverage lies on top of it, therein lies a crisis. The sources of this crisis, to my mind, were three. One came from the international capital market. We had a period in which real interest rates were very low for a generation, simply because most of the world's great economies that were doing saving had very broken domestic financial systems. That saving flowed into an international capital market, largely, though not exclusively, in this country, and real interest rates were very low. When I'm with students, I often ask them, in talking about this crisis, if I tell you that real interest rates are low for a long period of time, the prices of which kinds of assets will rise? The answer: assets with a long life. Housing is not a surprise that it was the star in the show. This isn't an American issue. It was a global issue and baked in the cake of very low real interest rates. The second is monetary policy. I think U.S. monetary policy made a significant error in the period 2003 to 2005. You'll hear Rick at lunch. He may have a different point of view on that. Policy's ease during that period of a boom in the economy both poured gasoline on a fire for asset price bubbles, but it also gave wind to any transaction that profited from the spread between extremely low short-term rates and longer-term rates. Teasers and subprime mortgages are merely an example of that. And the third factor lies in capital regulation. We thought the Basel capital accords were excellent. Instead, they were more like Swiss cheese and led to a set of regulatory arbitrage possibilities. Now, the Fed and the Treasury have been very active in the United States. I know you'll talk about today. I can be brief simply by saying I think the Federal Reserve has done a very good job managing through an extremely difficult crisis. I think the Treasury's job has been mixed, or performance has been mixed, but both of them together have taken actions that clearly are helping. What should policy do in an environment like this? I think really four things, all beginning with a C. The first is confidence. And to promote confidence in private markets, you have to have principles. And so the Treasury can't simply resolve each institution as if it were different from the one before. That is not a way to build confidence in private markets as to what is going on for investment purposes.